Hey everyone, thank you for joining us today. Welcome to another Three Things Thursday. I'm Bill Bourbonnais, and today we're going to talk about a question that I get more often than you might expect. That question is, can I deduct money that someone didn't pay me? Now, in the last couple of weeks, I've had two clients ask about this. One was a business loan that had gone bad. The borrower defaulted on the loan and on 5 figures of interest payments. The second was a question on whether a $250,000 contract that was canceled could be deducted. These are great questions and they come up more often than you would think. So here are three important distinctions for this. First, number one, expected revenue versus recognized income. Expected revenue isn't the same as recognized income. A signed contract feels like money, you plan around it, and you forecast around it, but for tax purposes, income has to actually be earned and recognized before it can affect your tax return. The same applies to the defaulted interest payments. If the borrower never made the payments, there was no income received, so there's nothing to write off. And if you're on the cash basis, the cash method of accounting, and never received the money, it was never included in income, so there's nothing to deduct. Thing number two, business setback versus tax loss. Not every business setback creates a tax loss. You may have lost opportunity, you may have lost momentum, you may even have lost expected earnings, but the tax law only allows deductions for specific economic events, not projections that didn't materialize. The third thing, thing number three, is your accounting method matters. Your accounting method plays an important role. If you're on the cash method, it's straightforward. No money received means no income reported and no deduction available. If you're on the accrual method, the answer can be more nuanced depending on how the revenue is recorded and whether an actual receivable has become uncollectible. For the client with the loan gone bad, while the lost interest isn't deductible, the principal amount he actually loaned may qualify as a worthless debt or investment, depending on the specific facts. So in closing, situations like this are a good reminder that tax law focuses on what actually occurred, not what was expected to occur. If you're unsure how something should be treated, that's exactly what a quick conversation can save confusion later. Before you assume something is a loss, make sure it's a loss the tax code actually recognizes. That's the difference between reacting and planning strategically. Thanks a lot for your time. I'm Bill Bourbonnais. We'll see you next Thursday. Have a great day.